Hey everybody, welcome back to the channel. We have a lot to talk about today because Cathie Wood just came out with another new podcast that we're going to be analyzing, and we're going to be going through her tweet thread today, or one of her ARC research members' tweet thread that she retweeted. That's really important to discuss, and I think it sums up sort of the main points of what she's talking about in that podcast. Overall, bottom line thesis, Cathie Wood and ARK Invest, which manages $55 billion of capital and has probably hundreds of millions of dollars to allocate towards research because the basis of their research forms the ability for them to allocate those $55 billion effectively, is predicting that inflation is transitory. Now, we've already known that her thoughts were that inflation is transitory. We've already known that she believes inflation is going to go away, but she's doubling down on that statement. And it's hard to say that someone's doubling down on that statement, especially with what we've seen in the market over the past, basically 3-4 weeks. I mean, things haven't really gotten that better. Valuations have gotten worse. We've had a little bit of bumps and then they came back down. Today, the day I'm recording this, February 9th, things are getting a little bit better, but it's likely going to come back down again, right? It's not like we're out of the bear market. We still haven't had the Fed raise interest rates yet, and we still haven't had the Fed do quantitative tightening. We are still printing $30 billion a month on the Fed's balance sheet. So because the Fed hasn't really done a lot of the stuff that they said they were going to do in order to make the economy less stimulated, right? In order to make sure things start slowing down, things haven't necessarily changed yet, or things haven't necessarily changed from the federal government's perspective of doing what they said they were going to do. As a result, people are very, very skeptical with what we're seeing in the market right now. People are primarily thinking, look, we haven't seen anything. Yes, valuations are bad. Facebook's obviously been crashing. Google went up to like 3,000. Now it's back down to 2,700 because like that was kind of a fake rally. The split kind of made it happen, but it can't sustain itself. So we're not necessarily seeing a crazy rally bring us back to even half of what we were before this whole entire market crash happened. As a result, a lot of people are still bearish on the market. Cathie Wood's perspective, based upon the podcast that she just came out with, is we kind of expected that this was going to happen, and it's probably going to persist. People are still probably going to be hawk because people still are probably going to say, oh, the Fed and interest rates are going to do worse things, and prices aren't baked into all the macro level changes that are going to happen. But she is steadfast on this argument that inflation is transitory. And if inflation is transitory, that means the necessity for the Fed to do massive amounts of quantitative tightening to get rid of inflation and destimulate the economy, and massive amounts of interest rate hikes. Some people are talking about 7 rate hikes a year. She does not think that's likely going to happen. Is going to go away because the only reason you do those things is to get rid of inflation. Because when you get rid of inflation, a lot of things start getting better for everybody. Prices go down, the world starts stabilizing more, people aren't so antsy, people don't start buying a lot of more things anymore, which means supply chains have to be good, inflation has to go down. Cathie Wood believes the opposite of what a lot of other people believe, which is that supply chains are really bad, and as a result, inflation is really bad, because if your supply chains are bad, your inflation is bad, because there's not that much inventory coming through the door, which means people have to buy more things, and the price of things goes up because there's not that much of stuff, sort of basic supply and demand. The more stuff there is, the more prices go down because demand neutralizes the actual cost of the supply. Cathie Wood is doubling down on this statement around inflation is transitory. Let's hop into this Twitter thread. Let's talk about what she's talking about, and let's talk about the logic behind why she thinks this is true. Ultimately, she's going to be right or she's going to be wrong. Either inflation is going to go away, and we're going to see it through the data, and we're getting CPI data tomorrow, which will be very interesting to see how she's how it's like trending, or she's going to be wrong, and we're going to be in a bad time for the market. So let's see the logic behind her thoughts. Okay, so this is one of the researchers in ARC, Sam Corsis. He says, what is the current demand for, this is basically summarizing the entire podcast that Cathie did. So let's sort of take a look at this. What is the current demand for vehicles? The University of Michigan Consumer Sentiment Survey asked, do you think the next 12 months or so will be a good time or bad time to buy a new vehicle? More people than ever said bad time, going all the way back to 1961. Very, very interesting statistic right here, as we can see from the survey. Now, why is this important? The University of Michigan survey is one of the most trusted surveys in regards to consumer sentiment. And Cathie and her team really relies on this survey to gauge how much are consumers actually feeling that they want to spend or they don't want to spend. So if the sentiment is down, the worst it's been since 1961 to buy a car, that means people believe that it's not a good time to put money into the economy to buy a car for whatever reason there may be. And there's a lot of reasons why they don't want to do it. But if that's the case, that means people are going to stop putting money into the economy. I mean, car sales make up a huge portion of the economy. And if people aren't putting money into the economy because they're not trying to buy cars, that should lead to a decrease of inflation. Second thing he says, but automakers claim demand is strong and point to low inventory on dealer lots. But is inventory on dealer lots? How much inventory is in people's driveways after buying a car to avoid public transport during COVID? So this is their argument that, look, a lot of time during COVID, people didn't want to get on the train or the bus because of the macro level effects of getting on the train or the bus, right? It would obviously cause danger to you, to your family, etc. So as a result, people bought their own cars so they could do different things to go away from that, so that they could avoid COVID. So when he's saying automakers claim demand is strong and point to lower inventory on dealer lots, he's saying that automakers are lying, right? Like that demand is not as strong as they think they are, and that low inventory is actually not that true. They're particularly talking about inventory actually not being as strong as it is or stronger than it is for cars, because there's just more supply because people aren't buying it. So if we look at this chart that he's saying right here, this is domestic auto inventories. This is the thousands of units that are bought per year. We're at the 1.3 billion. 1996, we're at a major high, and it's going down and down and down since 2021. As a result, we're having less and less people buy cars, and less people buy cars means there's less inflation that is likely happening. He then says, as semiconductors arrive, can selling a low number of cars quickly be linearly extrapolated to selling a high number of cars quickly? So basically what he's saying is that when we get a lot more semiconductors and the shortage necessarily stops and goes away, supply chains get better, are you just going to be able to be like, oh, we're selling a lot of cars quickly because we're selling a low number of cars quickly, but now we have all these semiconductors, let's sell a bunch of high level of cars. He's basically saying that's likely not going to happen, right? You're not just going to be able to sell all these cars just because you have more chips, because that's not how supply and demand works. He's also saying there's a shift in consumer preference towards electric vehicles, which means that big manufacturers like Ford, GM, et cetera, that are saying, oh, we have plenty of demand, we have plenty of inventory, are going to be backloaded on their inventory because consumer sentiment is changing to electric vehicles. As a result, they're not going to be buying those types of cars anymore, which means if they're not buying those types of cars anymore, that's less money going into the economy. Now, he says the average new car price in the U.S. increased over $11,000 in the past 3 years, which is kind of insane. I bought my 2019 Honda Civic for about 21 grand, negotiated it really well with my dad in 2019, and then I got into an accident. I had to pay $2,000 more. So the negotiation sucked because I had to pay for that's a whole nother story. Can the demand level of 3 years ago be expected at much higher prices? So basically saying, look, there is no way consumers are going to keep paying the amount of money that they're paying for these new cars, which means prices for these cars will go down. And when prices are going down, that is good for inflation because the consumer doesn't have to spend that much on goods that are being served. The low consumer sentiment for vehicle purchases is largely attributable to high prices, which suggests demand can't be sustained at these price levels. That means inflation goes down because higher prices are a function of inflation, right? Like people just don't raise prices to raise prices. They raise prices if they believe that their profit margins are going down because the value of the dollar is going down. So the car manufacturers have been able to raise these prices as a result of inflation and people were buying, but that's starting to switch. And that goes back to the survey that we talked about at the beginning. So he finishes off with saying, if supply is coming online as demand is dropping, it could lead to a number of players being caught offside with inventory. That's how we could go from a semiconductor shortage, which is inflation, fear, supply chain, to a glut. Now, I didn't know what glut meant. I looked it up, and it's basically short for gluttony. And I was like, oh, I know what gluttony means. I didn't know people use the word glut like that. But he's basically saying if supply is coming online, but demand's dropping, so we have more cars than people are buying, it leads to a number of people having a lot more inventory, which means a lot of prices are going to go down, which means inflation is going to go down. And that semiconductor shortage that we're having that everyone's so scared about is actually going to turn into a glut. We're going to have a gluttony of semiconductors. We're going to have a ton of semiconductors in this space. Let's see what Cathie said as she retweeted it. Consumers are rebelling against soaring auto prices. Auto manufacturers enjoyed pricing power during the COVID-related supply shock, but may regret moves that, along with soaring oil prices, have accelerated the shift to electric vehicles. This inflation is transitory. Her larger argument here is that with soaring oil prices, which is bad for the consumer, obviously, also bad for ICE vehicles, internal combustion engine vehicles, means the sentiment is going to start shifting to electric vehicles. And also people already bought a car during COVID, which means there's not this whole COVID surge of crazy, let's buy all this stuff because we don't know what's going to happen because of the instability of COVID, means that inventories are going to go up, supply chains are going to get better. A lot of companies in the auto manufacturing space and a lot of other spaces that exist in the global economy are going to have much more inventory than they know what to do with it, which means prices are going to go down and this inflation will become transitory. The backbone of this thesis, I believe, is this consumer sentiment argument that she's going for. The consumer sentiment argument is important because if truly consumers are believing that there is going to be, or if consumers are truly believing that it's not the right time to buy a car, which is analogous to a lot of other things that are in the macro level economy. It's not the right time to buy this. It's not the right time to buy that. If that survey is correct and you can apply that survey to large groups of people and that same sentiment almost reigns true for everyone, then that means people are going to stop spending money. And what you need in an economy when inflation is going high is for people to stop spending money, because that means there's less money being pumped into the economy. They also write about private business inventory. So one stat that she mentioned in her podcast, the Commerce Department report showed retail inventories shot up 4.4% in December after increasing 2.0% in November. Inventories of motor vehicles and parts jumped 6.8% after rising 4.3% in November. This means that there are more and more inventories that exist within these different factories, and there's more parts to these inventories that exist by a couple percentage of points, but that are pretty substantial if you compare them to the millions of cars and parts that exist. Which means that people have a backlog of inventory. And that backlog of inventory is not being utilized into the economy because you don't need that much inventory because people aren't buying. There's just not that much demand for the stuff that people are selling. They also write that retail inventories, excluding motor vehicles, accelerated 3.6% after rising 1.2% in November. So retail inventories, everything outside of cars, was also going up. Your laptops, your phones, your clothes, all of that stuff comes together in retail inventories. If on an aggregate, it's going up 3.6%, that means all of these companies, all these stores that sell stuff to us consumers have 3.6% more inventory than they need to have because it's just not being sold off the shelves. It's not flying off the shelves, which tends to see that consumer demand is going down, which means less money in the economy, which means inflation should be transitory. Now, a couple final stats I want to talk about. She says that U.S. retail sales sank 1.9% in the month of December. That's not good for the whole narrative that inflation is here to stay, because if December, which is the biggest shopping month of the entire year, retail sales are down 1.9%, that essentially means that people aren't buying as much. That means consumer demand is going down. As a result of consumer demand going down, that ultimately means that there should be less inflation if in the busiest month of the year, people aren't buying as much. Now, she talks about how there was a pop in the month of January, and that was expected. So U.S. auto sales actually rose in the month of January. All the analysis we did was about why U.S. auto sales are going to start to decrease, why inventories can't keep up the way that, or why inventories are going to be more expanding because demand is going to start to go down. But there was a rebound in December in which a lot of people started buying cars. That does not mean that cars are, or that does not indicate that there is still a lot of inflation and that people still want to buy because of all the other things we talked about for why they will start to not buy in the consumer sentiment survey, the demand dropping for retail prices, etc. But that does mean that there is a little bit of a rebound. And when that rebound happens, it is likely because it was really low the month before. As a result of it popping, it's likely going to start going down as well. Same thing she said for Amazon. Amazon reported 9% quarter-over-quarter growth. Now, from Q4 2021 or 2020 to Q4 2021 in their latest earnings. Now, 9% is not good for Amazon at all. Obviously, it was hard to keep up with Q4 2020 because that was the year of COVID and Amazon actually exploded in terms of how many people were buying things on Amazon. But nonetheless, 9% is still really bad. Facebook reported their year-over-year growth, and it wasn't really bad. They made $33 billion, but it wasn't as big as it could have been, meaning advertisers were spending less money. People were buying less stuff on Amazon. It's not that these earning reports were bad. It's just that when you look at them in their historical context, they aren't performing the way that it's expected to perform in general, mainly based on the fact that people just aren't spending that much more money, which means, of course, there's going to be a little bit pop in the next month, and maybe Amazon's going to have a lot more sales in February because there was a lot less sales before. That's what happened with car auto manufacturing. But that doesn't deny the macro level effects of all the stuff we talked about with EVs and consumer sentiment and demand prices, ultimately leading to the fact that this stuff is starting to go down and inventories are starting to get backed up and more companies are starting to have more than they can sell, which means eventually prices are going to have to go down. She also mentioned that Ford stock is incredibly tricky to her for understand because it's like Ford hasn't been up as much as it's been up since the year 2000, only off a report that they said we have incredible demand for our electric vehicles. And she's just like, this makes no sense. Like, we've done all this analysis showing that you don't have demand, you don't have the ability to build electrical vehicles at the scale of like a Tesla, you don't have the infrastructure, you don't have the billions of dollars committed, and you don't have people that are rushing to buy cars given everything we just talked about, even if there was a pop in the month of January. Which means as a result, the Ford stock is the real bubble to her, and also, as a result, it means inflation will go down because once that bubble gets popped, the companies that actually have the value and the value proposition to offer within the territory of electric vehicles or whatever other sort of deep category she's betting on that have been slashed from their valuations will start to go up as investors realize, oh wait, Ford was nothing. Inflation is going down. Why are we not putting our money in high growth tech companies that are able to grow during these times and capture market share? And that's when that transition is going to happen. Now, is she right of all these things? I don't necessarily know. I mean, there's a lot of analysis here that makes sense. Obviously, the pop in January of cars being sold seems to show that there is a little bit more demand for cars, but she's predicting that is inevitably going to go down. And that pop is a very temporary pop of cars being sold in January and demand being high, given demand was so low the month prior. But based on all the other trends she's acknowledging, that stuff is going to start to go down. And if that stuff starts to go down, and consumer sentiment also starts to go down, that means demand is going to go down and prices as a result have to go down because there's more supply that enters into the economy, which means if that's the case, inflation is transitory. I don't necessarily know if she's correct because it all depends on if supply chains, like the crucial variable here is, are supply chains going to be persisting over the next 6 months to the point where they don't have challenges? We know that companies in their earnings reports, Tesla, Apple, and Amazon mention that there are supply chain issues. Facebook mentioned the reason why advertising budgets are getting lower is because there are supply chain issues for those companies, which means they don't have enough money to allocate to advertising because they have supply chain issues. If all of this is true, then she may be incorrect. If all of this is true at the highest of levels, then she may be incorrect because that means supply chains aren't solved. And for her thesis to make sense, supply chains do have to start getting a lot better. But if these companies are kind of not exaggerating, but they're just kind of using it as an excuse and they're like, yeah, there's some supply chain issues. That's why don't hurt us too much. Like, it's really not our fault. Kind of what Facebook did with Apple. It's like, Apple screwed us over. Don't like blame us. And the investors definitely blame Facebook for not preparing for that. That means that supply chains aren't actually that big of a deal. And they are getting a lot better, especially if demand is going down. Supply chains are getting better because there's just more stuff, right? If there wasn't more stuff, demand wouldn't be going down because people would be so like greedy, right, and gluttonous to go get more stuff because they're afraid that they're not going to be able to get more stuff. But if supply chains are going down, or supply chains are good, that means there's enough stuff, which means there doesn't need to be that much demand. I think in the next 6 months, we're going to see if inflation can go down from 7% down to around 4 or 5%. I mean, if that can happen in the next 6 months, this is going to be insane. If that cannot happen, if inflation cannot persist down and it's going to be stuck in the 6.8, 6.9%, we're not steadily decreasing it, then that means inflation is likely not transitory and the Fed is going to have to be a little bit more hawkish. So it will be interesting to see ultimately what happens in this economy. Let me know your thoughts. Thank you guys so much for watching. This is a very, very interesting to discuss. So you get CPI data tomorrow. We're going to see a little bit on how what's going on with inflation. Likely still going to be around that 7%, but ultimately in the next couple months, if Cathie is right, inflation will trend downwards, supply chains will be better, demand will decrease, and that means money is going to go back into her high growth tech stocks that have been slashed and hammered over the past couple months because people think that inflation is rising, and that's why that money needs to go back into value stocks. Let's see what happens. Thank you guys so much for watching. My name is Amit. Looking forward to reading the comments. I'll see you in the next one.